Hello, my friends. Welcome to the channel. I am Nicole and I live in India. And today I'm going to be looking at a video from First Post. Now, they have done this recently, which is what is behind foreign investors relentlessly selling off from the Indian stock market. Now, this is a topic that I really am interested in because we, as a family have investments here. And I have noticed a huge sell-off in the last few weeks. Now, there was a bump when Trump was elected, and then about 3 days after, things just started to slide. So I would really be interested in finding out why the market has been going down. And if you are too, let's go ahead and watch it together. Now, if you haven't already, please give me your like, please give me your subscribe, and let's go. Go.
The past couple of weeks have been rocky for the Indian stock markets. Barring last Friday, both market indices, the Sensex and Nifty, have been on a declining trajectory. And this path is not new. Both market indices, Sensex and Nifty, have been declining since the end of September after hitting a new record high on the 27th of that month. And since then, they have slipped more than 10%. Analysts say one of the key reasons for this has been the foreign institutional investors, or FIIs. These are overseas entities or individuals who buy or sell Indian stocks and bonds to diversify their portfolios. And so far in November, they have sold a large part of their holdings in India. According to data from the NSE, it's approximately $4.06 billion. This foreign investment outflow has also put pressure on the Indian rupee. Since overseas investors convert their rupee holdings to dollars, demand for foreign currency rises. This increased demand has led to the depreciation of the Indian rupee to a record low against the US dollar. So, why are foreign institutional investors leaving Indian stocks? And what does their exit mean for the market? Let's try to understand. Foreign institutional investors are often considered a key driver for stock markets in many countries, and it has been the case for India as well. However, this year so far, foreign institutional investors have sold over $34 billion worth of shares and other assets. Just look at this chart. It shows how FIIs have bought and sold assets on the Nifty 50 index. In the last 11 months, they were net buyers in just 4 months and sellers in the rest. Their buying activity peaked in September with a record $1.8 billion in fusion. And since then, they have been selling their stakes relentlessly. In October, FIIs sold a record $13.5 billion in holdings, and the trend continued this month. There are multiple reasons behind the exit of foreign investors. First, let's start with the United States. The presidential elections in the country this month created uncertainty in global markets. As investors awaited the outcome, they pulled their money out of emerging markets and bet on safer assets like US government treasuries. According to analysts, this was further exacerbated by the increasing possibility of a new Trump administration, which has promised to impose high tariffs and adopt a protectionist approach for the economy, which experts believe would lead to high inflation and in turn high interest rates.
20% tariff would cause a lot of macroeconomic changes, and that's something that a president can do pretty much unilaterally without congressional approval. That would cause more inflation? Well, the ramifications of the national debt are that if that deficit is worsened significantly, that will mean that interest rates will rise. And on particularly long-term bonds, and that if that goes out of control, that higher interest rate will hurt the homeowners in terms new homeowners in terms of getting mortgages.
Both these scenarios, analysts say, will lead to foreign investors pulling money out of global markets. Another key reason for the exit of foreign investors from the Indian market has been China. China has been facing possible slow growth scenarios this year. It has introduced a series of stimulus measures to revitalize its economy. While most of these have been deemed insufficient, they have caused some foreign investors to go back, seeking higher returns. But there are domestic factors as well. The Indian stock markets have been on a rising path for the last couple of years. Both Sensex and Nifty provided yearly gains of over 20% last year. Strong economic growth, helped by a record rise in retail investment, had helped achieve these high returns. And before the decline started in September, both indices had touched new record highs. This led some analysts to believe that the Indian stock market may have been overvalued. The notion was further solidified as Indian companies started releasing their earnings reports for the July to September quarter. According to ICICI Direct, Indian companies saw their profits grow by just 3.6% during this quarter, which was the slowest growth in 4.5 years. Further reports noted that Indian companies saw an increase in their expenses during this period, both of which foreign investors seem to have noticed. But while foreign investors exit, domestic institutional investors are stepping up. These are Indian mutual funds, insurance companies, pension funds and banks. They have poured in a record amount of money into Indian equities. According to data from the National Securities Depository, as of the September quarter, domestic institutional investors hold about 16% of Indian stock markets, which is just slightly below foreign institutional investors who hold just over 16.4%. Experts say domestic institutional investors, along with retail investors, are increasingly playing a stabilizing role in the Indian stock market. Analysts say that while foreign investment is still a key market force, their control over the Indian capital market has decreased. This was evident as both Sensex and Nifty declined by only 6% in October, despite substantial sell-offs by foreign investors. And some analysts also see this decline in Indian stocks as an opportunity for investors to raise their holdings. This is because the stock market decline has led to lower prices. Others believe that this foreign investment outflow may not be permanent. They term it as a tactical adjustment rather than an exodus, citing the long-term growth potential of the Indian economy, which will in turn help the equity market eke out gains. Goldman Sachs predicts that the Nifty may rise about 3% in the next 3 months. So even as some foreign investors offload Indian stocks, analysts don't see this lasting for a long time. And in the meantime, Indian domestic investors seem to be providing a helping hand.
So that's good news, basically. So the foreign investors may have pulled out a bit, but India domestically stepped up. Also, I think it's really good that maybe we don't have such a huge foreign investment requirement, because it looks like, and they just said, with all of the sell-off, it was really only 6% that was affected. And that's good, right? We don't want to have something happen globally and then lose everything because the American economy is down, or some other economy is down, and that would so greatly affect our investments. So I think overall it makes sense. I can see why they've left, like the reasoning given, why they might have left, and whether or not they come back, I don't know. But I guess I'm okay that they left, and that information was correct. When the pricing is down and the stocks are down, that is a great opportunity for investment and to buy. And we will continue, I think, to invest in India and to buy stock here. So hopefully you do too. So that was a great video to watch. If you like the content, please give a like, please give a subscribe. And as always, I love you and bye-bye. Mwah.